Hi guys, this is lesson 10 of the Trading 101 series. In this lesson, we're going to be talking about margin. Stay tuned. Hi guys, this is Annie, aka the Not Trader, your friendly neighborhood swing trader, back again with another video. Remember to hit that like button, hit that subscribe button, and hit that alert button to get alerts on all my latest videos. I've got Facebook, Twitter, and Instagram at the Not Trader on all social media platforms. And if you check that description section below, you see a link to my mailing list, and you also see a link to my Discord group. Now, in this lesson, we're going to be talking about margin. If you haven't seen lesson 1 to 9, I'd recommend you watch them in order from 1 to 9 and then come to this video afterwards. Let's get straight into it. So, what is margin? Well, margin is the amount of money required in your trading account to make a trade. So imagine I wanted to take a long position on the FTSE 100. So as you already know from lesson 2, the FTSE 100 is an index of the top 100 listed companies on the London Stock Exchange. If the price of the FTSE 100 at the time I want to take my position is 7258 and the position size I wanted to take is £1 per pip, then the FTSE 100 margin requirement is 5%. So these margin requirements are predetermined. I want to go through that in the next slide. You have to just know that the margin requirement is 5% for indices. Then this is the equation you need to use to work out the margin requirement, which is the amount of money you need in your account to enter a trade, given the three different criteria that I've previously given. So you take the 7258, which is the current price, times the position size, which is the £1 per pip, and you times it by the margin requirement, which is 5%, which will give you 362.90. So £362.90 is what you need in your account as a minimum to take a position of £1 per pip at the price of 7258, given that the FTSE 100 requires 5% margin. So as you can see there that so as you can see there, £365.90 is 5% of 75. So as you can see here, £362.90 is 5% of the price, which is 7258. So this is the formula that you need to know when taking a position in a spread betting account, because so this formula is important to know when taking a position in a spread betting account, because if any of these factors change, the margin requirement change, and you should understand how they relate to each other so that you know how much you need in your account when taking a position. But most trading platforms, if not all, will give you a indication of the margin requirement needed if you fill in the information. As you can see on the right hand side, I've got the price tape, order tape of all the criteria I mentioned here. So this is the buy price, this is the position size, £1 per pip, this is the current price level, and it will naturally give you the margin requirement here. So if you have any less than that, they won't allow you to take the position, and you'll have to either top up your account or change one of these other factors. So that's whether you need to reduce the position size. Maybe I've reduced it to 50p. So in the previous slide, I said that the FTSE 100 had a 5% margin requirement. Now that number wasn't plucked out of the air. There's specific levels of margin requirement that are set for different equity classes by the ESMA regulation. Now in the previous slide, I said that the FTSE 100's margin Now in the previous slide I said the FTSE 100's margin requirement was 5%. Now that number wasn't plucked out of the air. there's specific margin requirements that are set for different asset classes, and these are the different margin requirements that are set for each of these asset classes because of the ESMA regulation that was put in place in June of 2018, I believe. So for forex pairs, it's 3.3%. For major indices like the FTSE 100, the DAX, the Dow Jones, it's 5%. For commodities, so that we're talking gold, silver, oil, I think, it's 10%. And for equities, so that's any stocks, US stocks, UK stocks, we're looking at 20%. And for cryptocurrencies, it's 50%. Now, these margin requirements were set because pre-June 2018, people had access to way more leverage. So let me take a step back actually. Leverage and margin requirement are interdependent of each other. But as you can see here, once you have higher margin requirement, you have lower leverage. But I'm going to discuss leverage in more detail in the next lesson.